Welcome to Value Vest Daily, not financial or tax advice. Today, we are bringing you a deep dive explainer on one of the absolutely most explosive, fascinating market events we've seen in the entire digital infrastructure space this year. We're talking about Hut 8. They trade under the ticker symbol HUT, and we need to unpack the massive market surge they just experienced. Look, this isn't just your standard story about a stock going up. It's a fundamental story about a company that is completely transforming its identity practically overnight. They're bridging the gap between legacy cryptocurrency mining and the bleeding edge of the artificial intelligence boom. So we're going to unpack the science, the financial mechanics, and the raw data behind this monumental shift. And when I say explosive, I literally mean explosive. Hut 8 delivered one of the biggest single-day moves we have ever witnessed in this sector, rocketing up roughly 35%. Just to put that into perspective for you, the stock closed the previous day right around $80.51, opened up north of $101, and touched intraday highs of $109 to $110. And the volume? Absolutely insane. We're talking millions of shares changing hands as Wall Street and retail investors rushed in to reprice the company based on a sudden fundamental catalyst. Now, if you held Hut prior to this breakout, congratulations. If you didn't, well, this might be the moment you wish you did. But the real question for us today is, why did this happen? And more importantly, is there still room to run?
Okay, let's dive into this. Here's our roadmap for this explainer. First, the explosive market breakout. Second, the Bitcoin to AI pivot. Third, the Beacon Point mega deal. Fourth, decoding Q1 earnings. Fifth, the power infrastructure supercycle. And finally, upside, risks, and momentum.
Let's start with Section 1, the explosive market breakout. The sheer scale of the market's reaction here was honestly staggering. This wasn't some slow, creeping realization. No, it was a violent repricing. Retail sentiment across platforms like StockTwits and X absolutely caught fire. Traders were calling this a monster move and declaring Hut 8 an AI miner 10x play. But listen, it wasn't just a retail frenzy. The institutional footprints on this were massive. We saw aggressive institutional options flow betting on continued upside. Specifically, the 90-strike call options traded at 22 times their normal volume. When you see smart money piling into out-of-the-money calls at 22 times the standard rate, it tells you right away that the big players believe this rally has serious legs and that the underlying catalyst represents a permanent shift in the company's valuation. Moving right along to Section 2, the Bitcoin to AI pivot. To truly grasp why the market is aggressively buying up this stock, you really have to look at the business model transformation. On one hand, you have traditional Bitcoin mining. We all know the story here, right? It's highly volatile. Your revenue fluctuates minute by minute with the price of Bitcoin. You're constantly dealing with the halving of block rewards, and it's incredibly energy intensive with margins that can just get squeezed completely dry during crypto winters. On the other hand, you have AI infrastructure. Now, this is what smart management teams do. They read the writing on the wall. Hut 8 realized they were sitting on an absolute goldmine of power and physical infrastructure. So by pivoting to lease this infrastructure to major tech giants, they are essentially trading the wild roller coaster volatility of crypto for the stable, predictable, high-margin cash flows of becoming a specialized tech real estate company. It's a real game changer. Let's pause and spend a minute on the actual science of AI power demand, because it's absolutely crucial to understanding this play. Right now, hyperscalers, think Google, Microsoft, Amazon, Meta, they are spending tens of billions of dollars on ultra-advanced AI GPUs like NVIDIA's H100s and the upcoming B200s. The science behind training these massive large language models requires running tens of thousands of these chips simultaneously. And guess what? They draw an astronomical amount of electrical current and generate massive, massive heat. You literally cannot just plug these things into a standard office building. You need dedicated physical grid infrastructure. Well, Hut 8 already has secured land in Texas with incredibly cheap power. But more importantly, they have existing energized substations. Building a substation from scratch, that can take years right now because of massive supply chain backlogs for transformers. Hut 8 has immediate capacity ready to deploy for AI GPU training and inference today. That is the critical physical bottleneck they are solving. And that brings us perfectly to Section 3, the Beacon Point mega deal. I want you to anchor yourself to this number, $9.8 billion. That is the base contract value of the blockbuster 15-year lease Hut just signed at their Beacon Point site down in Texas. This isn't some speculative, pie-in-the-sky projection. This is contracted revenue. And guys, it gets better. With potential extensions and renewals baked right into the contract, the total value of this single deal could reach a staggering $25.1 billion over its lifetime.
In the world of infrastructure leasing, locking in a tenant for a decade and a half for nearly $10 billion, that fundamentally changes the floor valuation of your entire company. Now, here is the kicker. It's all about how this contract is actually structured, which is as a triple net lease. If you are analyzing this from an investment perspective, this right here is the holy grail. A triple net lease means the tenant, which in this case is a massive, incredibly well-capitalized hyperscaler, agrees to pay virtually all the operating expenses associated with the property. The tenant pays for the massive power draw. The tenant pays for the cooling and maintenance. The tenant pays the property taxes. Hut 8, as the landlord, literally just sits back and collects ultra-stable, high-margin rent. It essentially turns Hut 8 into a REIT, a real estate investment trust, but for cutting-edge AI data centers. It completely de-risks the operating side of this specific facility while holding on to all that pure profit margin. So how does this actually build into their cash flow? Management expects the single 352-megawatt site to reach stabilization in 2027. Once stabilized, this one lease is projected to generate $655 million in average annual net operating income, or NOI. Let's talk valuation for a second. If you are building out a discounted cash flow or DCF model to determine if this individual stock is a buy, a highly predictable $655 million annual NOI is incredibly powerful. It allows analysts to drastically reduce the discount rate they apply to the company because these cash flows are no longer speculative crypto rewards, right? They are contractual obligations from high-credit tech giants. This is exactly why analysts are rushing to re-rate this stock from a risky miner to a premium AI infrastructure play. All right, Section 4, decoding Q1 earnings data. Let's address the elephant in the room that definitely confused quite a few people. If you just glanced at the quick headlines, you might have been scratching your head. But let's look at the actual operating business first. The data proves the pivot is working right now. Q1 revenue completely exploded. It was up 226% year over year to $71 million. That is real tangible growth. They are already generating massive top-line acceleration from their operations before the full weight of that Beacon Point mega deal even hits the books in the coming years. But wait, what about that massive headline loss? You probably saw the news alert screaming about a $253 million net loss. Let me demystify this for you real quick. That $253 million is almost entirely a non-cash digital asset mark-to-market loss. What does that actually mean? Well, under current accounting rules, if you hold Bitcoin on your balance sheet, you have to mark its value to the current market price at the very end of the quarter. If the price of Bitcoin dipped during that specific window, you have to record it as a loss on your income statement, even if you didn't sell a single coin. It is purely accounting noise. No cash actually left the building. And this is a foundational principle of investing. The market prices the future, not the accounting noise of the past. Wall Street completely ignored that paper loss today. Why? Because the future contracted revenue from these AI deals is the only thing that truly matters. With this new deal, Hut 8's total contracted AI capacity boosts to 597 megawatts. That represents a staggering $16.8 billion in base term contracted revenue across their entire portfolio. You simply do not sell off a stock over a non-cash paper loss when management just secured nearly $17 billion in guaranteed future top-line revenue. This leads us perfectly into Section 5, the power infrastructure supercycle. Remember that 352-megawatt deal that just generated nearly $10 billion? Well, Hut 8 has a jaw-dropping development pipeline of 8,375 megawatts. That is over 8 gigawatts of potential power capacity in development. If they execute and land even a fraction of this pipeline with similar AI data center deals, we are talking about transformative exponential growth. Honestly, the scale of their pipeline is almost hard to comprehend, and it positions them as an absolute dominant player in the future of the digital grid. Now, you might be asking yourself, why on earth are these massive tech companies going to crypto miners instead of traditional utility companies? It all comes down to the biggest supply chain bottleneck of our era. Hyperscalers are in a vicious AI arms race. They need gigawatts of power yesterday to train their models. Traditional utility companies, they're bogged down by immense bureaucratic red tape, permitting, environmental reviews, building new power plants. That takes 5 to 10 years. Tech giants literally cannot wait a decade. Enter the miners. Companies like Hut 8 offer low-cost, regulation-friendly power that is already secured and ready to go. They've got the land, they've got the high-voltage substations, and they already have the deep expertise in managing massive electrical loads. They are the ultimate plug-and-play solution for the AI boom. And finally, Section 6, upside, risks, and momentum. Look, while the upside is clearly massive, and peers like Riot and Coors are definitely watching this poster child closely, we have to do an execution reality check. Again,
If you are building out that DCF model to really determine if Hut is a buy, you absolutely must factor in the risks. First off, there are always construction and execution delays when you're building out multi-hundred megawatt campuses. Supply chains for those transformers and the specialized cooling equipment still very tight. Second, there is heavy tenant concentration risk. I mean, while a 15-year lease is amazing, relying on a single megatenant for a huge chunk of your revenue means their creditworthiness essentially becomes your creditworthiness. And third, despite this awesome pivot, Hut 8 still holds Bitcoin and still mines it. That means there will be residual Bitcoin price volatility affecting their balance sheet. However, as we saw today, the market is aggressively voting with its dollars, signaling that the premium valuation of AI infrastructure far outweighs these execution hurdles. So after digesting all of this data, the hardcore science behind the grid, and the massive financial implications of a $10 billion pivot, I have to ask you, Hut or no Hut? Is this your next 5 to 10x opportunity in the AI infrastructure boom? Are you buying the dip after today's massive run, or are you waiting on the sidelines to see if they can actually execute more of these deals? Please subscribe, like, and share ValueVest Daily for daily learning opportunities before you put your money to work. And one more thing, please put in a comment if you want us to deep dive into any specific high-risk/reward opportunities.